Hello everyone, this is Crypto Bit Law, back with another blockchain law, policy, and regulation update. Today is Tuesday, February 8th, 2022, and here are the major events transpiring in the digital asset space. The FDIC recently announced that it is going to be making assessing risks of crypto a priority for 2022. There was a Polygon DeFi protocol that was recently hacked for $13 million. Valkyrie Capital's Bitcoin Mining ETF is going to debut on Nasdaq today. U.S. crypto lobbying expenditures have doubled in 2021. European Union officials are weighing the potential Metaverse regulations that they could impose. And Russian billionaires are touting CBDCs in lieu of Bitcoin. So, as always, if you enjoy this content, please hit the like button and subscribe to our channel. It would really help us out getting this content and this message out there in terms of the algorithm and all that. And as always, you can find, if you want to just jump around to any one of these stories, you could find that in the timeline listed below. So, with that said, let's just jump right on in. All right, so first up on the docket today, we can see that the new FDIC acting chair says evaluation of crypto risk is a top priority for 2022. Martin Gruenberg said agencies like the FDIC need to provide a, quote, robust guidance to the banking industry on how to manage the risks to consumers posed by crypto assets. Acting Federal Deposit Insurance Corporation Chair Martin Gruenberg named evaluating crypto risks as one of the agency's top priorities for 2022 in a statement issued Monday. Gruenberg became the acting chair of the FDIC on February 5th following the resignation of Jelena McWilliams, who held the post since 2018. Gruenberg had served as an FDIC board member since mid-2018. Prior to that, he was the FDIC's chairman for a 5-year term starting in 2012. Quote, the rapid introduction of a variety of crypto asset or digital asset products into the financial system could pose significant safety and soundness and financial system risks, Gruenberg wrote. He noted that it is imperative that the federal banking agencies consider the risks posed by these products and determine how well banking organizations can safely engage in handling them. Quote, to the extent such activities can be conducted in a safe and sound manner, the agencies will need to provide robust guidance to the banking industry on the management of prudential and consumer protection risks raised by crypto asset activities, he concluded. Separately, the FDIC has still been trying to determine whether stablecoins qualify for pass-through insurance if they are offered by FDIC-approved institutions. So with this last point, I'm sure that most of you are aware that when you deposit money at a bank, you get FDIC insurance for up to about $250,000. And if there is a bank run or the bank goes under and you lose your deposits, the money you deposited at that bank, the FDIC insures those deposits at that bank for up to $250,000. And that's part of the issue that they were talking about here, whether or not digital assets like stablecoins would even qualify for that level of pass-through insurance that we could see here. And they're still trying to figure that out. The other thing is that, with the rise of these digital assets and these stable coins, the government is still trying to get a handle on how they're actually going to regulate these things, whether or not they're going to treat issuers of stable coins like Circle as de facto banks. And I think it's only natural that once they figure out that portion of the regulation that comes first, how they're actually going to treat the issuance and the handling and the regulation of stablecoin issuers, once they figure that out, Congress that is, then the FDIC can come in and then decide how they're going to treat the insurance of these assets and how they're going to treat handling the regulation of these digital assets, in particular stablecoins. So very interesting development. I mean, it's only natural that this is happening, since we have, the SEC and the Treasury and all these different federal agencies that are weighing in on the developments that are taking place in crypto, coupled with the congressional hearings that are trying to get a handle on crypto so that they can pass informed and effective legislation. I think that this is, kind of culminating in a perfect storm of all of these agencies coming together at once, and then they are going to piecemeal out this regulation and legislation. So it's going to first come in the form of legislation and then regulation for things like these banks or the stablecoin issuers being treated as de facto banks, or who knows? I mean, an alternative realm, we could have Congress passing legislation wherein the Fed gets to issue a CBDC or central bank digital currency. So I think first they need to figure out that, and then once those issues get hashed out, then these entities like the FDIC that are downstream from these other institutions like the Fed, like Congress, like the Treasury, they can pass legislation or they can effectuate regulations that go in line with what came before, the regulations that were passed further upstream. So, interesting development. all these links, to this guy's report. It's going to be in the description below, and this alternate article about whether or not they are going to, or how they are considering FDIC insurance on these stablecoins. All right, next up, we can see that according to this Decrypt report, the vesting contract for Polygon DeFi protocol QiDAO was exploited for $13 million. Hackers made off with more than $13 million in various tokens after exploiting QiDAO's superfluid vesting contract. They say Polygon-based DeFi protocol, QiDAO, fell victim to an exploit of its superfluid vesting contract on Tuesday, resulting in a loss of approximately $13 million. The QiDAO protocol allows users to borrow stablecoins at 0% interest against their crypto holdings. QiDAO acknowledged the exploit via Twitter. However, the team stressed that the vesting contract was exploited through a vulnerability in Superfluid, a smart contracts framework on Ethereum that enables users to transfer assets on-chain rather than QiDAO itself. As an aside, I think it's worthwhile to note that if this hack truly played out the way that QiDAO is alleging that it did, as a vulnerability in this superfluid smart contract framework, then it should raise red flags to all of these other protocols or projects that use that framework, that they better get on it to fix whatever sort of exploit is available in that system in order to prevent this sort of contagion from spreading to their projects. So always be, on edge and have your tapping dancing shoes on if you're involved with this level of DeFi right here. But continuing on, the report continues that while QiDAO insists that user funds are safe, crypto analytics Slow Mist estimates that hackers managed to get away with more than $13 million in various tokens, including Key, Wrapped Ether, USDC, SDT, Mocha, Stack, Curve, and Matic. So as a result, following the incident, the price of QiDAO governance token, Key, plummeted by more than 70% from $1.24 to 18 cents, before rebounding to 70 cents by press time, according to CoinDeco. So, naturally, the protocol gets exploited, and then the governance token gets wrecked. No surprise there. The report continues that the exploit also comes a day after Polygon, an interoperability and scaling protocol for Ethereum-compatible blockchains, raised $450 million in a funding round led by Sequoia Capital India. So, this is just a continuation of these DeFi protocols, vulnerabilities in these DeFi protocols, these smart contracts being exploited, and then end users left holding the bag when their coins magically disappear or they're left with no liquidity in the contract. I know last week we saw there was that wormhole bridge contract that was hacked, and then a few weeks before it was something else. I know they had this what was the name of this project? Poly something. There was another Poly something related project that was hacked. Every week it seems like it's almost a different exploit with one of these smart contracts, especially in the DeFi space. So if you're going to be getting involved with this stuff, you really have to be aware of the risks involved and be able to stick and move and get in and get out. It's not like Ron Popeil with the rotisserie chicken thing where you just set it and forget it. You really have to be aware and be on the up and up of these types of vulnerabilities and be able to, get your money in and out after really getting your alpha and taking some profits. Never be afraid to take profits in this game. So, all right, next up, we can see that a Valkyrie Capital Bitcoin mining ETF is going to debut on Nasdaq. The ETF will be traded under the ticker symbol WGMI starting today, February 8th. They say Valkyrie Capital's Bitcoin mining ETF focused on renewable energy has been approved by the U.S. Securities and Exchange Commission, and it's set to go live today, on the Nasdaq under the ticker WGMI, a crypto community acronym for We're Gonna Make It. The Valkyrie Bitcoin mining ETF primarily is focused on companies that use at least 77% renewable energy. According to the application filed at the end of January, 80% of the ETF's assets are focused on companies that earn at least 50% of their total profit from Bitcoin mining, which requires massive amounts of energy as the network's, quote, miners compete to solve complex puzzles to earn Bitcoin and help secure the blockchain. Well, that's a very simple way of explaining mining, but continuing on, the Valkyrie Bitcoin mining ETF's largest holdings are Argo Blockchain, Bitfarms, CleanSpark, High Blockchain, and Stronghold Digital Mining. They say the SEC last month rejected applications from Fidelity and First Trust Advisors and Skybridge for spot Bitcoin market ETFs. Corporate interest in cryptocurrency appears to be on the rise, with accounting and auditing firm KPMG's Canadian division just announcing it invested in both Bitcoin and Ethereum. So, This right here, this point for me, the rejection of the spot ETF, I mean, that's kind of the rub here. We have all these instances where the SEC is approving these Bitcoin and digital asset related ETFs, whether they be a futures derivative Bitcoin ETF or something like this Bitcoin mining ETF, but still the big daddy of them all, the spot Bitcoin ETF, that's still sitting in limbo. Now, I know we've discussed these reasons in the past. Essentially, it's just the SEC trying to get control over, their observation and their ability to track and try to prevent manipulation in the market because, Bitcoin is such a volatile asset that big moves on exchanges that aren't under US-based jurisdiction. So like, let's say you have an exchange that's based in Singapore or one that's based in Taiwan or one of these other foreign jurisdictions, and it's not under the thumb of the SEC or the American government. You could have severe price manipulation that occurs on those markets over here that will naturally affect the price of Bitcoin in American-based markets. So, in part because the SEC doesn't have the ability to monitor and regulate those markets and try to eke out any sort of manipulative practices over there, they're more hesitant to release the ETF over here because the prices over here are affected by what's going on in those foreign jurisdictions through things like arbitrage trading and so on and so forth. Plus the fact they're trying to get a handle on the regulation of Bitcoin mining and Bitcoin and digital assets in general in order to prevent a metaphorical Pandora's box where this whole digital asset space kind of blows up in their face before they can control it in the form of regulation. So, imagine a situation where they actually release a spot Bitcoin ETF and then big institutional money and retail traders can finally get exposure to this and everybody apes in and there's already, historical low levels of supply of Bitcoin on the open market. And then this ETF is going to be forced to buy spot Bitcoin from the market. And it's just basic laws of supply and demand. Very little supply, very high demand, price moons. And then you have this situation where people are like, why am I hanging on to dollars when Bitcoin just keeps mooning? So for all of those reasons, I think that's why we haven't seen a spot ETF yet. But it's interesting to see that they've actually approved this Bitcoin mining ETF. All right, next up, we can see that the U.S. crypto lobbying expenditures doubled in 2021. Here are the biggest spenders. They say Ripple Labs spent the most on crypto lobbying in the United States over the past 5 years, with expenses totaling $2 million. Cryptocurrency advocates in the United States have been increasingly putting efforts to support the industry, with crypto lobbying spending growing significantly in recent years. Crypto-related lobbying expenditure in the United States totaled $4.9 million in 2021, more than doubling from $2.3 million in the previous year, according to a new study by the crypto analytics startup CryptoHead.io. The study is based on lobbying tracking data obtained from research and government transparency group Open Secrets. According to CryptoHead's findings, the total lobbying expenditure over the past 5 years amounted to more than $9.5 million. Back in 2017, the total spending on crypto lobbying equaled as low as $200,000. And see, we could see a chart right here of just the overall increase of expenditures for these lobbying efforts year over year, with a notable increase over time. As CryptoHead estimated, the U.S. crypto industry's lobbying expenditure at roughly $5 million, some analysts suggest that the industry is spending way more on things like political initiatives. According to a report by Americans for Financial Reform, Wall Street executives, their employees, and trade associations invested nearly $3 billion into political initiatives during the 2020 election cycle. The industry's advocates group Blockchain Association, Coinbase Crypto Exchange, and blockchain platform Block.one. According to the data, Coinbase was the biggest spending lobbying blockchain company in 2021, with expenses totaling over $1.3 million. Next up, we can see that the European Union weighs potential Metaverse regulation, according to a report. Authorities need to understand the Metaverse better in order to decide the best course of regulatory action, according to one of the EU's commissioners. They say the European Union is analyzing the Metaverse and the potential actions needed for regulatory control, Executive Vice President of the European Commission, Margrethe Vestager said. Vestager said that authorities need to understand the Metaverse better in order to decide the best course of regulatory action. Quote, the Metaverse is already here, so of course we're start to analyzing What will be the role for a regulator? What is the role for our legislature? Vestager said in an online event on Tuesday, according to a report by Reuters. Everything we do must be fact-based and based on information that we can get. We need to understand it before we can decide what actions would be appropriate, Vestager added. So, I mean, it's just interesting to see that these governments are actually starting to acknowledge things like the metaverse and consider how, to regulate and govern and pass laws that will affect how the metaverse operates. Imagine, I would always joke with some of my friends, imagine trying to serve someone a copy of a lawsuit or a subpoena in the metaverse. I'm sure at some point rules like that are going to be hashed out. And I think that that's just one example of the type of things that these legislators need to consider in order to, pass common sense legislation and regulations with regards to how the metaverse will operate and govern itself. All right, and finally, we can see that Russia's second richest man has his sights set on a digital ruble, not Bitcoin. Billionaire Vladimir Potanin believes Russia's financial future is in a central bank digital currency and the tokenization of real-world assets. Decrypt reports that Russia's second richest man believes digital tokens and a central bank digital currency would help the country move forward and make the current debate in the country regarding cryptocurrency regulation pointless, according to reports. Business magnate Vladimir Potanin, who is worth $30.4 billion, said that the advancement in the world of tokenization would, quote, squeeze unreliable products out of the market in a Monday Bloomberg interview. Russia is currently at a deadlock about what to do about cryptocurrency regulation. The country's central bank said that last month that Bitcoin mining and transactions should be banned, citing concerns about the amount of energy that these activities consume. But the finance ministry added that it would be, quote, necessary to allow these technologies to develop, and regulation instead was needed. President Vladimir Putin then called for a compromise, but he did say that Russia has, quote, certain competitive advantages when it comes to mining cryptocurrency due to an energy surplus in the country. But Potanin, who is close with President Vladimir Putin, said that the real future in Russia is the tokenization of real-world assets, not decentralized currencies such as Bitcoin and Ethereum. Potanin added that a CBDC, in this case a digital ruble, could also help the country advance. A CBDC is a digital version of a fiat currency, like the US dollar or the Russian ruble, backed by a central bank. They are different to cryptocurrencies like Bitcoin and Ethereum because they are centralized and tightly controlled. The report also notes that a number of nations have already banned cryptocurrencies like Bitcoin. A report by the Global Legal Research Directorate, the GLRD, of the Library of Congress states that 9 countries, including China, Egypt, and Morocco, have an absolute ban on cryptocurrencies, while another 42 have an implicit ban. So, I mean, it's not really surprising that a Russian billionaire would want to maintain the status quo of fiat hegemony in the form of CBDCs, a natural evolution of these fiats that would take form in these CBDCs. Because, I mean, he has nothing to gain but everything to lose from a shakeup of the financial system brought on by the type of disruption that Bitcoin and Ethereum and traditional blockchain-based cryptocurrencies could see. So, I mean, this report really isn't all that shocking, but I think it's interesting that it brings in that dichotomy or that contrast with Putin actually realizing, hey, this could really be something for our country. We have a surplus of energy here, and we can actually leverage that to mine Bitcoin and act as a leader in this space. So, interesting take. I think that's going to pretty much wrap it up for today. I hope you guys enjoyed this content. If you did, please hit the like button. We would really appreciate that. Even better if you could subscribe. That would be even better. We'd love that. You can also follow us on Twitter. Our handle is @CryptoBitLaw. And with that said, thank you guys for watching, and we will see you all in the next video.